Welcome to this video on the US inflation problem and its consequences. Our monthly forecast meeting focused on US inflation. This was mainly due to the unexpectedly high inflation data for March, which was published last week. But consumer prices had also risen much faster than the Fed's 2% target in the previous 2 months. Inflation is picking up again after falling significantly in the second half of last year. Inflation is rising primarily because the prices of mostly labor-intensive services are moving up faster again. This in turn is due to quickly rising wages. Fortunately, however, the rise in wages is slowing down again. Wages will not push up service inflation for much longer. In the medium term, services inflation is even likely to fall again if wage growth continues to weaken, partly due to strong immigration. Because inflation has been unexpectedly high in recent months, we have raised our inflation forecast for 2024 as a whole from 3.0 to 3.5. For next year, however, we were able to confirm our previous forecast of 3%. We thus remain significantly more cautious than the majority of economists. The inflation problem is unlikely to simply disappear. As US inflation has recently been unexpectedly high, the Fed is unlikely to cut its policy rates already in June, but only after the presidential elections in December. Overall, we now expect only 3 interest rate cuts instead of 5. This is no longer a classical rate cut cycle, but only an adjustment of monetary policy. In contrast, the ECB has already committed to a first rate cut in June. We continue to expect a total of 4 ECB rate cuts. The expected decoupling of the ECB from the Fed increases the euro's expected interest rate disadvantage and argues in favor of a further depreciation of the euro. We now expect euro-dollar to move to 104 towards year-end. Also, the euro is already cheap in terms of purchasing power parity.